In 2026, the wealthiest companies on Earth are making a bet unlike anything in history. Amazon, $200 billion. Google, $180 billion. Microsoft, $120 billion. Meta, $130 billion. In a single year, more than $660 billion is being poured into AI infrastructure. That's more than what was spent on telecom infrastructure during the entire dot-com era of the 1990s, which totaled $500 billion over 5 years, mostly funded by debt. Today's AI spending is funded by cash flow. Everyone is betting on the same thing: artificial intelligence. But here's the critical question. Will this astronomical investment actually push the S&P 500 and NASDAQ 100 higher? And by how much? Wall Street bulls say AI will send stocks soaring once again. But a Nobel Prize-winning economist says the GDP impact will be just 1.6% over an entire decade. Today we'll examine the data from both sides and project where the S&P 500 will be in 2030 under 3 different scenarios. Let's start with how the major Wall Street institutions forecast AI's economic impact. Goldman Sachs believes AI could boost U.S. productivity growth by 1.5 percentage points per year over the next decade. Translated into S&P 500 earnings, that lifts the 20-year average EPS growth rate from 4.9 to 5.4%. A 0.5 percentage point difference may seem small, but compounded over 20 years, it raises the S&P 500's fair value by 9%. JP Morgan is even more aggressive. They see an AI supercycle driving 13 to 15% above-trend EPS growth for at least 2 years. Their 2026 S&P 500 target is 7,500, with a bull case above 8,000. Morgan Stanley's numbers are more impressive still. They project AI infrastructure investment reaching $3 trillion by 2028, with AI software revenue alone hitting $1.1 trillion. Long-term, they estimate AI's total addressable market at $40 trillion, based on the entire global labor market. McKinsey estimates generative AI alone could add $2.6 to $4.4 trillion annually to the global economy. Including all forms of AI, that figure rises to $15.5 to $22.9 trillion per year by 2040. And here's the important point. This time, real earnings are backing it up. Look at NVIDIA's data center revenue. In 2022, it was $3.75 billion per quarter. By 2026, it reached $62.3 billion per quarter. That's 16 times growth in 4 years. These are actual revenues, not expectations. Of course, much of this revenue is simply big tech's CapEx being spent. It's the infrastructure seller's income, not proof that AI is generating economic returns. But the difference from the dot-com era is clear. In 2000, the S&P 500 trailing PE was 33, and the NASDAQ exceeded 200. Today, the S&P 500 trailing PE is about 25, with a forward PE of 21. And the investment is funded by cash flow, not debt. Now let's look at the reality. In March 2026, Goldman Sachs chief economist Jan Hatzius made a stunning admission. AI's contribution to U.S. GDP growth in 2025 was, quote, basically zero. But wait, doesn't that seem strange? According to McKinsey, 88% of companies have adopted AI, yet GDP impact is zero? Here's the key insight. Adopted AI and achieving productivity gains from AI are completely different things. Let's look at the numbers. McKinsey says 88% of companies have adopted AI, but only 7% have scaled it across their entire organization. And just 6% attribute more than 5% of their operating income to AI. Gallup surveyed 23,000 American workers. Only 10% use AI daily, Even including weekly users, it's just 23%. BCG discovered what they call the silicon ceiling. 78% of managers and executives use AI weekly, but frontline workers? Stuck at 51%. The gap is driven by lack of training, limited tool access, and absent leadership support. What about the executives themselves? An NBER study surveyed 6,000 global executives. Their average AI usage? Just 1.5 hours per week, and 90% reported zero measurable productivity impact. The failure rates are even more striking. Industry estimates suggest 80% of AI projects fail, a figure supported by Rand Corporation analysis. An MIT study found 95% of AI pilot programs delivered zero measurable P&L impact. Of the $684 billion invested globally in AI in 2025, more than 80%, roughly $547 billion, failed to create its intended value. In short, companies have bought AI, but they haven't yet learned how to use it. So the question becomes, is AI actually useless? No. The problem isn't AI itself. It's how companies are using it. History gives us the answer. When Edison commercialized electricity in 1882, factory owners simply replaced steam engines with electric motors. Same factory layout, same workflow, nothing else changed. For the next 40 years, productivity gains were minimal. But in the 1920s, companies that completely redesigned their factories around electricity saw productivity surge to 5% per year. The Dow Jones rose sixfold in 8 years. The way companies use AI today looks exactly like the 1890s. They're plugging ChatGPT into existing processes without redesigning the work itself. Only a tiny fraction have restructured their workflows around AI. This is called the productivity J-curve. In the early stages of a new technology, productivity actually drops. The investment has been made, but the organization hasn't adapted yet. Then, once a tipping point is reached, productivity explodes upward. Electricity took 40 years. The internet took 20. AI's adoption speed is the fastest in history. But faster adoption doesn't mean faster organizational redesign. The bottleneck isn't how fast you can install AI. It's how fast you can reinvent the way you work. Here's the most striking evidence. A research lab called Meta gave experienced developers AI coding tools. The result? They were actually 19% slower, but they were convinced they were 20% faster. They underestimated the time spent writing prompts, reviewing outputs, and making corrections. Then there's Klarna. Their AI chatbot replaced the work of 700 customer service agents and reportedly saved $60 million. A massive success, right? But then, customer satisfaction started dropping. The CEO admitted they had, quote, focused too much on efficiency and sacrificed quality. They began rehiring humans. On the other hand, companies that successfully redesigned their operations show overwhelming results. JP Morgan invested $2 billion in AI and recovered $2 billion in cost savings. They now run over 450 AI use cases, and fraud prevention alone has prevented $1.5 billion in losses. Logistics company C.H. Robinson deployed 30 AI agents, achieving $346 million in efficiency savings and boosting productivity by more than 40%. Early adopters average a $3.7 return for every dollar invested in AI. Top performers? $10.3 per dollar. The bottom line is this. Simply adopting AI doesn't work. You have to redesign the work itself around AI. And the gap between companies that get this right and those that don't is growing wider every quarter. Now let's project 3 scenarios for the S&P 500 in 2030. Currently, the S&P 500 sits at roughly 6,900 with earnings per share of about $272. But before we look at the scenarios, we need to address a structural issue. The Magnificent Seven, Apple, Microsoft, Nvidia, Google, Amazon, Meta, and Tesla account for about 34% of the entire S&P 500. During the dot-com era, the top 10 stocks were about 25%. Today's concentration is even higher, and the CAPE ratio stands at 37 to 39, the 98th percentile in history. Why does this matter? Because in every scenario, valuation compression is a factor. Today's elevated interest rates add further downward pressure on PE multiples. Even if earnings rise, if the PE multiple falls, the index goes nowhere. Keep that in mind. Scenario 1. Bull case. AI productivity revolution materializes. Goldman Sachs and Morgan Stanley's optimistic forecasts come true. AI boosts annual productivity by 1.5 percentage points starting in 2027. EPS grows 12 to 15% per year, reaching $540 to $600 by 2030. But even in this scenario, valuation compression is likely. Historically, when EPS grows rapidly, PE ratios tend to revert toward their mean. With PE compressing to 20, the S&P 500 reaches roughly 10,800 to 12,000. Annual return, about 9 to 12%. Scenario 2. Base case. Gradual adoption, delayed impact. This is the most likely outcome. AI productivity gains emerge, but slower than expected, just like every previous technology revolution. EPS grows 8 to 10% per year, reaching $400 to $440. Valuations gradually drift toward the historical average PE of 18 to 20. The S&P 500 in 2030 reaches approximately 7,200 to 8,800. Annual return, about 1 to 5%. Vanguard reaches the same conclusion. Their paper titled AI Exuberance, Economic Upside, Stock Market Downside, argues that AI could push economic growth to 3%. But stock returns? Only 4 to 5% annually. Why? Because the market is already too expensive. Scenario 3. Bear case. Disappointment and valuation compression. AI underperforms expectations. Sequoia's $600 billion revenue gap closes more slowly than hoped. AI's productivity impact stays closer to Acemoglu's pessimistic estimate of just 1.6% over a full decade. Corporate earnings aren't bad. EPS still grows 3 to 5% per year. But it's not the 12 to 15% growth the market was expecting. There's also an overlooked variable here: share buybacks. S&P 500 companies spend $800 billion to $1 trillion annually on buybacks. A significant portion of EPS growth comes not from AI, but from shrinking share counts. The actual AI contribution may be smaller than it appears. As disappointed investors lower their expectations, valuations adjust. The trailing PE of 25 gradually drifts toward the historical average of 18. EPS rises, but PE falls, and the index stagnates or declines slightly. The S&P 500 in 2030 reaches approximately 5,500 to 6,500. Annual return, -1 to 4%. It's not a spectacular crash, but over 5 years, returns fall short of inflation. This may actually be the most dangerous scenario because it erodes your purchasing power quietly without any warning. Let's wrap up. What happens if you just sit in the S&P 500 passively? Our probability-weighted expected return is 3.9% per year. Not terrible, but a very different world from the 13% annual returns of the last decade. But 3.9% is an average, and averages don't exist in reality. What actually happens is that some companies will multiply tenfold while others go to zero. The probability-weighted expected return of 3.9% is essentially the same as our base case scenario. That tells you the market has already priced in a significant amount of AI success. So the real question isn't, will AI push the index higher? The question is, where are we now, and where does the opportunity shift next? Remember 3 phases. Phase 1, infrastructure, GPUs, data centers, semiconductors, NVIDIA, TSMC, Broadcom. This is already priced in. NVIDIA's trailing PE is 37, forward PE is 23. Upside from here is limited. Phase 2, applications. We're just entering this phase now. Companies selling AI as a tool, software, SaaS, and cloud platforms. OpenAI at $25 billion ARR, Anthropic at $19 billion, Cursor at $2 billion. This is still early on the growth curve. However, most of these companies are private. To access Phase 2 through public markets, look at Microsoft for OpenAI exposure, Amazon for Anthropic, or AI-enabled SaaS companies like Salesforce and ServiceNow. Phase 3, productivity realization. This is the phase not yet priced into the market. Traditional companies that are actually using AI to increase profits. JP Morgan, saving $2 billion annually through AI. C.H. Robinson, boosting productivity by 40% and expanding operating margins by more than 500 basis points. These are the early signals of Phase 3, and here's the most important signal to watch. Remember the 88 versus 7 gap? 88% of companies have adopted AI, but only 7% have actually scaled it. The moment that 7% climbs to 20 or 30% is the J-curve inflection point. That's when productivity explodes, EPS growth accelerates for real, and the next true rally begins. So here's my answer. Don't just sit passively and accept 3.9%. Know where to look and prepare while you wait. Don't go all in on Phase 1. It's already expensive. Watch Phase 2 as it enters the early growth stage, and search for the companies leading Phase 3, the ones already turning AI into real profits. In our next video, we'll analyze the Phase 3 candidates, non-tech companies that are actually generating real profits from AI. Subscribe and turn on notifications so you don't miss it.